excited to introduce our esteemed speaker, Steve Volle. Steve is Vice President, Real Estate Lending at California Coast Credit Union. Steve is a native San Diegan who's been working in real estate lending for more than 37 years. Steve has been with California Coast Credit Union going on 8 years, and we are so lucky to have him. And with that, Steve, take it away.
Thanks, Will. Thanks, everybody. Good afternoon. I'm hoping for the next 40 minutes or so, you will get some good information about home equity lending and the options available to you, not only through this credit union, but through any lender. We're going to be very agnostic with what we're talking about today with respect to products, and will be very generic in the nature and talking over the options available to homeowners today. One thing I will share with you is that currently we're doing record numbers of home equity loans, and that's primarily due to the tremendous appreciation that homeowners in San Diego and California have seen over the last 3 years. And with interest rates on first mortgages up, in the high sixes, low sevens, and folks that have very low interest rates on their first mortgages, this becomes the most viable option and strategically the best way to pursue it. So hopefully, as we go through this, little housekeeping, Will said we'll take questions at the end. Hopefully, if you have a question on a topic or a slide that I present, you'll go ahead and ask it during that, and Will can forward that to us. I like some lively engagement with these types of seminars when you don't have a live audience. Participation is greatly appreciated if you do have questions. So bring that on. So what I want to do is just kind of give you a quick overview of what we're going to talk about today. We're going to talk about homeowner equity, what that is. Then we're going to also talk about something slightly different, which is lendable equity. And that's what lenders typically define as what they will give you as far as loans, the maximum that they will go against the property. Additionally, then we'll talk about uses of equity. What most homeowners have, the biggest asset they have in their portfolio is their home. And the best way to utilize that equity is through potentially getting a loan. And that's what we'll talk about, is the loan options available, whether it's a refinance loan or an open-end or a closed-end second. And we'll get into that, as well as the key concepts associated with that. So hopefully with this, we can launch further into that. Now let's talk about homeowner equity. And everybody has a different understanding, but basically, equity in a property is based on the current value of your home less what you owe. And in this example, I think the average price of a home in San Diego County is north of $800,000. But let's just assume, for our discussion and for all our examples, I think we use this. $800,000 is, if that was your estimated value or your appraised value today, and you had a current first mortgage on that property of $450,000, your equity in that property would be about $350,000. And that's money that you have to, if you were to go and sell the property, that you can go and access that. Or as we will move forward, the equity in your property, that potentially that you can borrow from. So homeowner equity is the greatest amount of equity that you have in your property. Then we have something that we refer to as lendable equity. And lendable equity is the maximum amount that a lender starts off looking at that you can actually borrow. And in our example, typically the most common amount is 80%. So 80% of that $800,000, which would be at $640,000 less what you currently owe at $450,000, we would be looking at lendable equity of about $190,000. And in the lending community, what we typically want to have is some level of equity in the property. And in this case, it's 20%, which is kind of the standard. That's a Cal Coast. I can share with you that that's something that we abide by. There are lenders that will go 90 or 100%, but all of those variations from this kind of standard, there's different. There might be higher rates or different terms associated with each type of that. But in general, my reason for talking about both homeowner equity and lendable equity is typically lendable equity is less than the total equity in the property itself. Okay, and I don't know that anybody, that's pretty straightforward, so I'll continue to move forward on that. So equity. We have this huge nest egg of value with 40% appreciation in the last 3 years. Huge appreciation, regardless of whether you paid your mortgage down or not. Your home value has gone up, therefore increasing your home equity. And one of the hardest things to do is you can't spend equity unless you do something. Either you sell the property and take the proceeds, or that you look at financing options. And equity can be used for a lot of options, a lot of opportunities. You can finance home improvements. You can fund college education, or you can get ready for college education, any number of things. You can consolidate bills. And in many cases, if you have credit cards, a home equity loan could be a good vehicle to lower the cost and pay off those bills quicker, particularly with the current credit card rates out there. The other thing is you can look at purchasing a vehicle. With the high cost of cars today, even though auto rates are lower than traditional mortgage rates, the term of the loans are shorter. That the car payments these days are approaching $1,000 a month. So the equity you could use in your home is another way to defray some of those monthly costs in a loan on the property. Additionally, if you have a lot of equity, we have seen folks use the equity in their existing home to buy a second home or buy a rental home as well. And that's just one of the key functions of taking advantage of the equity that's appreciating in your house. I don't think anybody has any questions about that. Pretty straightforward with respect to that. What I would then talk to you about is what are the typical options available to folks today if they want to buy a property, or if they want to refinance their property. And prior to COVID and the very beginning of COVID, when mortgage rates were very low, doing a cash out refinance, that is getting a new first mortgage, was the option, because interest rates were so low, and it was a very easy way to get additional funds at a very low rate. And we'll go into the options on that. The other is to get a second mortgage, and that is leaving your first mortgage alone and getting an additional loan that's a fixed rate, and it's just a term loan. You get it and you start paying it back. The third option, which offers the greatest amount of flexibility, is a home equity line of credit. And so these are the three options that I want to talk to you about as far as going forward with what our members have been doing, and some of the figures that work out for them to either do a new home equity loan, a cash out refinance, or a line of credit. So in this first scenario, I apologize, there's a lot of figures here, but I'm going back to our original scenario. And if you were looking at option one, let's call it, and then again, we're assuming this home of $800,000, 80%, and our members owe a loan, have a current loan on the property of $450,000. Now, a majority of homeowners today have interest rates that are below 4%. For this example, let's say that they have 3%. And they're looking to get the maximum lendable equity out of the property of $190,000. Well, in this case, in this scenario, if you were to get a new first mortgage, you would go and get a new loan for $640,000. That is enough money to pay off the current first mortgage, plus the additional equity available of $190,000. Now, in this scenario, under current rates, if you took out a new loan for $640,000 at 7%, you'd be looking at a principal and interest payment of roughly just under $4,300. Now, one of the challenges with this is that if you're taking out $190,000, you're repricing that $450,000 from 3% up to 7%, and actually taking on a higher payment overall. So that may not be the option. And with the majority of our borrowers today, that is not what they're doing, unless they have a relatively low loan amount that they're looking to borrow. So what are our options? If rates are high right now and I don't want to give up a 3% or a 3.5% interest rate, what can I do in order to tap the equity that's in my property? I have a kid going off to college and I want to make sure I have money to fund that education. And it's sitting in my house. I don't have it in my savings account, but I have that tremendous equity in my property. So that one of the options that they would look at possibly then is, let's look at option 2, we'll call it, which is getting a home equity second. And that is a loan. We leave the first mortgage alone and we go and get a loan for $190,000. And in this scenario, this is a loan that's basically for $190,000. And when the money is lent, the principal and interest payment is calculated from the get-go, and now with the new loan they have a first mortgage payment and they have a second mortgage payment. And in this scenario, if you look at obtaining that $190,000 loan, I put in a scenario of a 7.75% 20-year fixed rate loan. We leave the current first right where it is, receive that $190,000, and now you have payment on 2 loans. Now, in this scenario, the payment between the first and the second is $3,463 roughly, which compared to the other example is substantially lower. And what we've basically done is we've segregated the debts. We've kept that 3% where it is and not repriced that money, and then we've added a second loan. So in this scenario, folks would be maximizing their borrowing and keeping their cost of funds on the 2 loans to as low as possible. And that's a great scenario. But let's say you get that $190,000, but your child isn't starting school for 6 months and the first tuition payment isn't due right away. Is there any other option that I can use to potentially get the money in place, but not have to spend it until I need it? And that's the second option. Again, and this would be what we'd take out on a home equity line of credit. This is also leaving the first mortgage alone, and then we go and obtain a line of credit, which gives us a limit up to $190,000. And we'll get into the payment a little bit differently. But one of the things then is you can get this loan in place, but then you won't have to use the money right away. And I'll talk further about that. But in this scenario, you obtain the new $190,000 loan. Our home equity loans generally are interest-only payments. We leave the current first in place, and you have the access to $190,000. In this scenario, if you were to take out the maximum, the $190,000, you'd have the first mortgage payment plus the second mortgage payment. In this scenario, the payment is even less than the previous scenario where it's roughly $3,130. Now, there's caveats associated with it. It's an interest-only payment. My rationale for showing you 3 examples is in home borrowing, there's always a variety of options. And some of it you have to look at, first of all, what's your financial personality? What are you most comfortable with in looking at payments? An interest-only payment may not be something that you want to look at because, hey, you're not paying off the principal. It's a great tool, gives you a lot of convenience. Other folks say, I want just a fixed payment. I want to be ready with it and pay it as I go, and I want to pay it off. I want to know the term and be done with it. And so in the current environment, really getting a new first mortgage, unless it's a relatively low loan amount, is not a viable option or not the best option relative to the market. And we would look at the home equity line of credit or the fixed second. So I'll stop there. And Will, I don't know if there's any questions in the chat, but please let me know real quick.
There is a question
Okay.
as it relates to tax advantages. They wanted to know, what is the purpose of a home equity loan as it relates to any tax advantages?
It's a great question, and a lot of those have been reduced. I will say my caveat is I'm not a tax advisor. We do issue, and all lenders issue an interest a 1098, which actually talks about the deductibility. And so depending on your tax situation, I know that the deductibility on that has changed. My best recollection is that if it's used for home improvement, there's rules that allow you to do it, but those have been significantly diminished. My discussion and my whole emphasis in looking at these options is more on, I hope it comes across, in structuring, trying to get the lowest payment for the maximum amount of money and with the features and options associated with it. So I'll defer on that question and just say I'll leave it to your tax advisors if I can escape that. Okay. So let me move forward a little bit with these scenarios and talk about key concepts and features associated with the loans. So if you were to get a new first mortgage or a new fixed second mortgage, what ends up happening is if you're getting additional cash out, you get a lump sum of money when the loan closes. So you get a chunk of change and you're ready to go. The other aspect of that is you're going to get a fixed principal and interest payment, and it's going to be a closed-end loan, meaning that once you start paying it back, it's amortized, and the payments over time, whether it's a 20-year or 15-year, each payment has principal and interest, and you will pay it back during the stated period of the loan, which will be different than, say, a line of credit. The other point is once you get the money, you start paying it back immediately. So if you had a project or a future expense, you may get the money today and start paying it back today, where you may not actually incur the expense till later on. So there may be advantages associated with getting a line of credit where your expenses due later on. Because in this case, if you close the loan, you get the money and you're starting to pay it back right away. The other aspect of it is a closed-end loan, meaning that once you borrow that $190,000, that loan is done. You can't, if you pay it down to $150,000, you don't have the ability to go and draw back up to that original $190,000. So that's a feature associated with a closed-end loan, which is atypical for a line of credit, and thus some of the features associated with a line of credit make it much more attractive for, say, a situation where you have future expenses or expenses over time. And so let's go on to that, and let's look at the home equity line of credit. And first of all, I put a picture of a guy that's very carefree, because the home equity loan has a lot of wonderful options associated with it, but there's caveats with that. There's challenges with that. And the one thing is that you can access cash when you need it. So when you think of a home equity line of credit, think of basically the same functionality as you have with a credit card. You can get a credit card, say, for $10,000, but you don't pay anything unless you use the credit card. That's the same thing with your line of credit. You get approved for a limit, and then generally you can have credit card access to it, or you can have checks associated with it, or you can have the money shifted over from your loan right into your online into your checking account and write checks with it. So that's a tremendous feature associated with it. Now, some of the downsides that folks, when we go back and forth and talk to them about it, is it does have an adjustable rate feature associated with it. So your payments can fluctuate. But in that scenario, we also have interest-only payments during the draw period, which is a key difference. And with many of our home borrowers, they really like the lower payment associated with a home equity line of credit, because it gives them greater flexibility in structuring. They can make the minimum payment, or they can can always pay more, but it gives them some relief associated with borrowing the money and not having a full principal and interest payment. And then the other benefit of it is it's a open-end loan, which means if you took it up in our scenario to $190,000 and you paid it down, say you used it for business, or you're in a line of work that you get bonuses, you can pay it down and put lump sums of money on it. Let's say you paid it from $190,000 down to $150,000. You have the ability to access that $50,000 for for up to during the draw period, as long as it's available. So it's kind of a revolving line that allows you to use it over and over again, unlike the fixed closed-end loans that we talked about previously. Now, with home equity lines of credit, because of the nature of the loan that you're able to draw during draw period that can be as long as 10 years, there are other features associated with it. One of the key ones is it's an adjustable rate. And some folks like that, some folks don't like that. Typically, home equity lines of credit are geared to the prime rate, and as the prime rate goes up or down, the rate on the loan goes up or down. With that in mind, currently we're probably at the higher end of the market with the prime rate at the highest it may or may not be. So if you were to be contemplating a home equity line of credit as your option going forward of the three that we talked about, chances are over time your payment might actually go down because the prime rate, if there's talk of future rate cuts, as rate cuts were to occur, the prime rate would come down with that. So just something to think about. The other aspects of it are that when you go and get a home equity line of credit, and I thought this was a very pondering picture, like there's a lot of features associated with it. You get approved for a credit limit. So what we typically tell folks is get approved for what you can qualify for, which may be higher than what you actually need. But the minute you need more money, you have to go back and get a new loan. So in this scenario, if the borrower had equity up to $190,000 and they were only asking for 150, we might encourage them to look at getting the maximum amount, because you only pay on what you borrow. And having that additional amount of money provides a tremendous benefit. Even though you don't use it, it doesn't cost you anything. The other aspect of a home equity line of credit is that you have a draw period. That's a period of time that's stated in the loan with all lenders, where you have this revolving ability to take money out, pay it back, take money out, pay it back. And typically draw periods are 10 years. And so you have a 10-year window where that loan during the draw period remains interest only, and you have a lot of flexibility because you can pay things down, take it back up, and continue to use it as a source of money as you need it. The other aspect, like we talked about the adjustable rate, there's also how often does the interest rate change and what are the functions associated with that, and how much can your payment change associated with that. When you look at adjustable rate loans, whether it's a first or a second, you always want to look at the worst case associated with the payment. What could it be if I had the maximum loan amount and the maximum interest rate? And some of these interest rates on these loans go up as high as 18%. Mind you, they're geared to the prime rate. And in the current marketplace, like I said, we're probably at the higher end of where the prime rate would be, with talk of potentially future rate cuts coming down the road. The index on the loan, that's how your interest rate fluctuates, and you can look at the prime rate and see where that is. And then many lenders, including Calcos, depending on your credit, will have an interest rate margin that's associated with that. That you have the prime rate, and then your rate might be, you'll hear the term prime plus one or prime plus two. That is what your actual interest rate may be associated with the loan. And as I mentioned before, knowing if we're at the higher end of rates, well, maybe it's less important to know what that maximum interest rate is today, but you also want to know what the minimum rate is. Is your minimum rate capped at a higher amount or a lower amount, so that you can know the worst case, the highest your payment could ever be, plus the lowest your loan can be. And then lastly, we have the repayment period. The repayment period is once it goes from the revolving interest only period of the 10, like say, for example, 10 years, the repayment typically is a 15-year repayment where the loan remains an adjustable rate, but all the payments going forward are calculated based on the interest rate change to pay off the loan in 15 years. So at that point, it becomes a principal and interest loan. And generally, with our membership, a very low percentage of our folks actually get to that period. they either refinance and combine it with their existing loan or put it into a first, or they refinance it at some point into another interest-only line of credit. So that gives us the greatest capacity for them to borrow. So again, we've talked about three real options in the current marketplace to access your equity. And I'll make a comment. All of our scenarios indicated that, if you had a first mortgage, you would get a second. If you're fortunate to have your home paid off, you can still get a second mortgage on it if the amount works to your needs over the first mortgage as well. So you can do a new first mortgage, as we talked about, probably at higher rates. You can do a fixed second, which would give you standard principal and interest payments in addition to your current first mortgage, or you can do the line of credit, which gives you that revolving feature associated with your loan and allows you to access what you need at the time you need it and then pay it back and have the ability to draw on it going forward. So those are the kind of the key concepts that I wanted to cover today. I'll see if anybody at this point, Will, has any questions.
Yeah, Steve, a lot of questions regarding terms.
Okay,
And I don't know if you can break it down again, the draw as it relates to on the HELOC, you talked about a draw period and a repayment period. What
sure.
are the terms on that? And then as it relates to interest rates, you did cover it, but what's the maximum interest rate that a lender could charge? And along those lines, if it's tied to prime and prime goes down, will a lender reduce the rate as well? That when prime
Yes.
goes down?
Yes. So the great question. So again, looking at the terms, we're trying to be agnostic and not tell you about specifically our program, but home equity loans in general. Typically, loans have a 10-year draw period with a 15-year repayment. Again, during the draw period, you only pay interest only. There are some loans that do principal and interest, and I don't want to confuse you on that. But for the majority, during the draw period is when you can have the ability to pay it down and advance on it. And during that period of time, you're making a payment that typically just covers the interest that's required to make the payment. Once you go beyond that 10 years, typically the repayment is 15 years where it pays everything. Now, the interest calculation, how the interest rate moves is the same throughout the whole 25 years if you were to take it to term. It's just that during the first 10 years, it's interest only. And during the remaining 15 years, you can no longer advance on it and you're paying principal and interest. And so the next part of your question was, what's the maximum interest rate? Some of these are as high as 18%. And so they can go up dramatically. Now, you'd have to look at the index, if it's the prime plus the margin to see where we would be. Our maximum interest rate, to give you an example, is 12%. And if it's prime plus one, if the prime is at 8.25, you might be looking at, say, 9.25 as an interest rate. And if we're at the higher end of the market, then you can maybe look at that as that's the high end of where your interest rate would be. With that said, as the interest rates come down, that is a function of the product, regardless of who's operating. As interest rates come down, depending on your adjustment frequency, you could see your payment adjust as frequently as monthly as the prime rate comes down. And generally, the prime rate, you don't see an adjustment every month. It might, as they come down or go up, it would raise a quarter here, a quarter there. So you may see that come down if those do. But lenders will bring the interest rate down as interest rates come down per the contract of the loan agreement itself.
Great, Steve. Thank you. Well, that was a lot of great information. I just want to remind everybody, if you have a question, please utilize the Q&A function at the bottom of the screen or put it in the chat. I do want to introduce our business development manager, Andres de la Mora. He's available if you have any other questions. Andres?
Hi, everybody. Thank you for joining the webinar. Steve, you did a great job. I just wanted to offer my services here. I'm the business development manager for Cal Coast Credit Union. I have a team of 7 of us that can help you with any product or services related questions. I have some real estate experts on my team, as well as the branches have some real estate experts, and obviously Steve's department. So if you have any questions, I'm going to put my contact information with my email and my phone number. You could call me or text me at that number. And if you have any questions during this time, I'm happy to answer them on the chat as well. I wanted to promote something real quick before I wrap up. We just turned 95 years here at the credit union, and we have a great certificate special at 9.5 rate of return with as little as $500 to start that certificate. So if you have any questions regarding that certificate or any specials or product services, please don't hesitate to reach out. Thank you so much.
Thanks on this. And Steve, some more questions for you. One related to appraisals. Are appraisals to determine the value performed by the credit union or bank or independent appraisers?
Great question, and I'll defer that to it's all of the above. Now, because of the appraisal rules, all appraisers are assigned through the lender. At Cal Coast, we do something known as an automated valuation. As our first line, it's an effort to provide a low cost opportunity. We have a no cost loan, so we do an AVM, and I would say that that works for 90% of homes in San Diego County, where it's fairly straightforward. There's good comparables and whatnot. If you were somebody that bought a house and did a lot of improvements, an AVM is not going to reflect that. So we would look at we have a next level of a virtual appraisal where we actually do it with a cell phone and assisted, the borrowers actually assist, and then we would actually do a full appraisal. In all of these scenarios, they're all ordered by the institution, whether it's Cal Coast or another lending institution. So they will rely on a value based on their lenders. They are typically independent of the institution, although there are some banks that have staff appraisers.
Excellent, thank you. Another question in regards to HELOCs. Is HELOC the best option for funding a new construction of a ADU or a JADU?
It depends. And again, I could say for a certain member it's yes, for another member it's no. One of the things that I would factor into the consideration is the duration of the project. If you're looking at a project that's going to take a year and you're not going to need all the money, I could make an argument that getting a line of credit today to take out the loan and you're paying as you go. Remember, if you're getting a lump sum up front and you're not getting billed for the construction right away, and you're doing it over time and you're accumulating it, you could argue that maybe it's better to get I can make an argument for a line of credit where, hey, your construction estimate might be, I don't know, say $200,000, and you have an opportunity to get a line of credit for $250,000. On any home improvement show that I've seen in remodeling, the actual cost ended up coming in higher than what the construction bid was. And so having that flexibility of a line of credit could allow you to offset those unexpected costs if you went higher. But I can make an argument for either, depending on one, the financial personality of the borrower, and two, the duration of the project. The other aspect of it is, where are interest rates going to be down the road, and what is the current mortgage on the property now to provide flexibility. I could make an argument, if you didn't have a loan on the current property, you could actually fund an ADU construction with a new first mortgage. So I could make an argument for all three, based on the characteristics associated with the property and how it's currently financed. So that's a more specific question, but the variables, the good news is you have options and you can look at how those come to bear based on the unique features associated with each loan type. So hopefully that's a non-answer with some qualified options available. So I'm not hedging the question. It's just going to be property specific to the actual borrower.
Excellent. Thanks, Steve. And what about investment properties? Can a borrower get a HELOC for an investment property?
Great question. And I know for CalCoast, we're one of the few that currently does that. We have done that my entire time here. I know that there's not all lenders do non-owner occupied. I will clarify that because the market recognizes a non-owner occupied property as a slightly more risky transaction, as you know, if you're going to stop paying, you typically are going to continue to pay on your house and maybe not pay in a downturn of a market. So the risk associated with the non-owner occupied property, if you lose a tenant or any other options associated with it, there's a higher risk associated with that. And for that purposes, if we're looking at a loan to value maximum for home equity lines of credit, they're generally lower, and the interest rate associated with it is a little bit higher. But yes, we do that, and it's one of the, well, I think we're one of the few in San Diego that still do it.
What about loan to value on the investment property?
I think the maximum loan to value on that is 65%.
Okay. And do those
instead of
homes,
80.
does the home, whether primary or investment, have to be in California for us to loan on it?
Great question. All lending for California Coast Credit Union is in the state of California only. So the property must be located in the state of California. You may need to go and find an institution local to the property if it's outside the state for financing. But we only, for our purposes, we only lend in the state of California.
Okay. And then the another question relates to the difference or advantages or explanation as far as HELOCs versus reverse mortgages for elderly parents who are house rich but cash poor.
Great.
Can you speak to that?
Yeah, I'll speak briefly to that. And one of the features associated with that is that a home equity, in many cases, we've run into situations where you have elderly parents that don't have income to qualify. So there's some challenges associated with that. Looking at a reverse mortgage, it's a great option to keep people in the house, but the rules associated with a reverse mortgage is that the borrowers have to reside in the residence during this entire time. So it has to be an owner occupied property. And there's challenges associated with that if for some reason in their elderly state that they are no longer living in the property. Remember, the qualifying is great and the money, goes out. There's no payment on it. So it's a great option. But in anything of that significant of a nature, I think you would have to look at, again, the characteristics of the borrowers, the property, the heirs involved, and finding out what is the best, what is the goal that they're trying to achieve. And I would make an argument, I've seen where it's worked, reverse mortgages worked perfectly for folks where in other situations, a line of credit was perfectly useful for somebody else. So with reverse mortgages, there's a great deal of education that needs to be done by the homeowners, and I would definitely look at both options to find out what's the best. But I will in generic say there are benefits associated with both based on the features, the qualifying requirements, and what's offered with both of those. So again, that's going to be an individual question, but I'll defer and say there's benefits associated with both.
Okay. Another one relates to the underwriting. Is the HELOC based on the equity and or debt to income?
So great question. Most lenders are not equity lenders, although it's a consideration when we look at the overall qualifying. It's what we call a compensating factor. So we do look at a debt to income ratio. We want to make sure that you have an ability to repay your debt. And so your maximum loan amount, while we calculate your equity at that 80% threshold, if your income is substantially lower than what's needed to support, say in our example, that $190,000, we would lower that limit. Now we do get more creative with that. We can take assets such as retirement accounts and IRAs and stocks and whatnot, and we can extrapolate a value from that in an effort to derive income for qualifying purposes, but it's a function of both. So we're looking at a debt to income with consideration to the equity in that. And sometimes we'll take a higher ratio if the equity position is fairly low, if it's a case by case on those. But we do a great deal of creativity when it comes to looking at maximizing borrower's ability to get a higher home equity line of credit. Hopefully that answers the question.
Another question where we had a member take a look at our more information on our website. So there was a question on how often does the rate adjust on a HELOC, and then as it relates to rate and APR. When the rate is 7% and the APR is 7%, the question is the payment 14% on the amount drawn?
No. So let me back up. First of all, the rate will adjust if the interest rate changes. If there's no change in the prime rate, the interest rate won't adjust. And while I wanted to stay product neutral, we do on our primary, we have an intro rate on our loan for the first year. So the rate is set, I believe, at 7.75 for the first year on an owner-occupied property. Having said that, the payment can adjust when the prime rate adjusts, and it can adjust every single month. And forgive me, the other part of the question escapes me right now. What was the other thing that they asked on that?
The 7% APR
the
rate
APR.
and APR.
Yeah. So to be clear, the APR is the true cost of the money taken into account the cost of the loan. Since we pay all the closing costs on the loan, the APR is the same as the interest rate because there's no additional costs associated with acquiring the loan. So the APR there's somebody that when you look at a traditional home loan, you can see an interest rate of say 7%, but with the APR it's 7.54. That's taking into account the additional cost of the loan. So it's not only the interest rate, but the costs associated with getting the loan that are deemed finance charges, and it's higher. On our loans, because we do pay the closing costs, the APR is the same as the actual interest rate.
Which was the next question relating to closing costs. So
yes. So to be clear, I'll start with CalCoast. We have we pay all the closing costs, with the exception that as long as you keep the loan for 3 years, you don't have to pay anything back. If you were to pay off the loan before 3 years, we will have an early termination fee, which is basically the cost that we put out to fund your loan, which would run probably $500 to $700 in general terms as far as that goes. But as long as you keep your loan open, and that you could have a zero balance, it's not meant to be punitive. It's just that if you're not going to use it, we want to recoup our costs if you go forward. Mm-hmm. So 3 years. If you keep it for 3 years, there's no minimum balance that you have to keep on the loan. There's no fee. Now that's not the same with all institutions. So you have to look at that and factor that into your overall consideration.
Thanks, Steve. Another question might be for Andres. Do you have to bank with California Coast Credit Union in order to get one of these home equity products?
Yes, you do. So whenever you get any product here at the credit union, it comes with your membership, which is a savings account. That's an easy process. If you join the credit union, now I can give you an incentive to join the credit union and an additional incentive to get a real estate loan with us. But yes, the question is, yes, you do have to be a member, but it's just a savings account if you like. It can come with a free checking account also. So yes.
Great, thank you. Another question came in. What if you do not own a home? What is the best loan option?
That's a great question. And what I'll state is that anything that's secured by property, for example, an auto loan, there's collateral associated with it, generally affords a lower interest rate. So if you have a car that's paid off, or if you have a car that has a low balance on it that has equity, generally that's a good place to start. And then it's just a question from there, what other options are available? Andres, do we have on our signature line of credit that what can you speak to anything about that? Don't mean to throw a curveball at you.
So I can put a link to our information on the signature line of credit.
Okay, but I would,
Um,
yeah, again, just in general terms, if you have collateral, which would be an auto loan, would be the next thing that
mhm.
allows you to borrow against something if you have available. Otherwise, it's unsecured, and that's going to always carry with it a higher interest rate.
I'm putting some info in the chat right now regarding signature
Great,
lines of credit.
great, great.
Steve, what is the best resource? People are having questions about reverse mortgages. How can they get information about that?
That's a great question. What I can maybe do is we can maybe broadcast that. There's the FHA administers that, and they have a lot of good sites. I would recommend AARP. They have good resources on the pros and cons associated with it. There's guidebooks that put out. If you even go and look at some of the TV advertisements, I think the latest one, I think Tom Selleck promotes, and I'm not promoting Tom Selleck, but because it's so highly regulated, there is value to actually getting their booklet when they send it out, because part of the process of doing that is that you have to go through an education, you have to get a certificate in order to demonstrate that you're aware of all the features associated with it. So I wouldn't be opposed to even going that far. Unfortunately, maybe they get your name, but I would Google it. I definitely start with AARP, and they may give you some good tips on that as well.
I might want to add also, we have a free financial wellness resource called Enrich. I'll put the link in the chat. It has thousands of videos, articles, tools, calculators on every personal finance related topic that you can imagine, including what is home equity, what's a home equity loan, what's a home equity line of credit, and also what is a reverse mortgage. So check out Enrich. It has thousands of articles, videos, and tools to help you answer some of those questions. It's absolutely free. I'm going to put the link in the chat right now so that you can have access to it. You do not have to be a member to access this. Check out any of the information in there about reverse mortgages. If you have further questions, feel free to reach out to Andres or myself. Our information is in the chat, and feel free to reach out to us if you have any questions. Okay, so I'm going to type that in right now. Any other last questions before we sign off?
I believe one came in. Do we offer reverse mortgages? Did we answer that one?
Yeah, we do. And just to be clear, we do not.
Right.
Present time.
And is there an age limit to getting a reverse mortgage?
There's a minimum age requirement, and I will just speak to that. I don't know the specific. I think it's 62. It could be younger. I shouldn't even venture that because it may have changed. But if you're a married couple, they go off of if there's two folks that are on the property, they go off the younger age of the two for calculation purposes. So.
All right, Steve, thank you so much for all that information. Thank you, everybody, for joining us today.